You might notice your grocery bills rising even when you buy the same items. This happens because prices can change after delays, making everyday expenses increase without clear changes in your shopping habits. One reason costs rise unexpectedly is due to hidden increases in supplier expenses, such as higher fuel or material prices. Each step in producing or transporting goods adds layers of costs that build up over time. Businesses have incentives to keep prices stable to avoid losing sales, so they often absorb small cost increases temporarily. This constraint delays price changes, but also reduces profit margins until prices must adjust. When costs rise behind the scenes, companies face a trade-off between raising prices or reducing quality. This balance affects how openly price increases appear at the checkout and influences customer perceptions. For example, if fuel costs rise sharply, transport companies pay more but may delay increasing delivery fees. Therefore, final retail prices reflect cost changes only after a lag, causing sudden jumps that seem unexpected. Fixed contracts with suppliers can lock in prices temporarily. When these contracts end, businesses face sudden cost increases that must be passed on quickly, creating irregular price changes consumers may not anticipate. Inventory management also affects timing. Companies buying stock in advance at lower costs can delay passing on cost increases until those inventories run out. This explains why some prices stay stable despite rising costs elsewhere. Suppliers weigh the risk of losing buyers if they raise prices too soon, which creates a careful timing strategy for cost changes. This incentive means prices adjust only when cost pressures become too large to absorb. Regulations or tariffs can suddenly add new expenses to goods. These external costs provide little flexibility for companies to manage prices gradually, often causing abrupt spikes passed on to consumers. Seasonal factors influence costs as well. Demand surges in certain periods push prices up. Businesses anticipate this and incorporate it into pricing, so these adjustments can feel unexpected outside the seasonal context. Currency fluctuations affect import costs. When local currency weakens, imported goods become more expensive, creating indirect cost increases that consumers notice only after currency changes impact supplier prices. Inflation expectations influence how often businesses adjust prices. If companies expect general inflation, they may raise prices more frequently, causing steady rises instead of sudden jumps. This shapes how costs evolve over time. Labor costs rise due to wage increases or shortages, which companies incorporate into product prices. Because wages adjust slowly, their impact on costs appears gradually but steadily, influencing prices over months or years. Energy costs can rise unexpectedly due to supply constraints or geopolitical events. These rapid increases create immediate pressure on production expenses, which then translate into higher consumer prices. When companies compete in tight markets, they may delay passing on cost increases to avoid losing customers. This trade-off means prices rise less predictably and can jump once cost absorption is no longer sustainable. Technological improvements can reduce costs in some areas while increasing them in others. This creates complex price dynamics, meaning overall cost changes do not always move in one direction and complicate consumer expectations. Supply chain disruptions, such as delays or shortages, add unexpected expenses that companies must cover. These constraints push prices higher when alternatives are limited or replacement costs are significant. Market power affects cost transmission. Dominant suppliers can set higher prices more easily. This means cost increases may be amplified rather than absorbed or delayed compared to competitive markets. Retailers balance inventory turnover and pricing strategies, deciding whether to sell existing stock at old prices or mark up new inventory. This choice causes variability in when and how price changes appear to consumers. Unexpected cost rises often result from a combination of delayed adjustments, strategic timing, and external shocks rather than a single cause. This complexity explains why price increases sometimes seem sudden or unexplained. Consumers experience cost increases due to layered decisions made upstream, showing how interconnected pricing systems are sensitive to many small changes. This mechanism highlights the indirect nature of price formation. Understanding that price changes reflect a balance of incentives and constraints helps clarify why costs rise unpredictably. It shows pricing as a result of strategic responses to ongoing input cost fluctuations. Unexpected cost increases arise because businesses manage timing, risk, and competitive pressures to protect profits and customers. As a result, prices adjust in uneven and sometimes delayed ways. In summary, cost increases appear unexpectedly because the pricing system balances hidden expenses, delayed reactions, and strategic decisions. This results in uneven timing and magnitude of price changes consumers observe.